Did you know that you can use the value of your current home to buy a new property without even having to sell it first? Today, I'm going to show you exactly how you can tap into your home's equity to expand your real estate portfolio or even find your dream home step by step. Now, let's talk about what home equity actually is. Think of your home equity as a piggy bank sitting inside of your house. Over time, every time your home value goes up, it's like dropping a big old coin right into that bank. And every single time you make that big old mortgage payment, you're adding a little more too. Over the years, this piggy bank fills up, holding value that you can tap into. There are two main ways that this piggy bank fills up. The first way is through home appreciation, which is just the increase in value of your home over time. As the value of homes in your area go up, your equity, your piggy bank, just grows bigger automatically. The second way is by paying that mortgage balance down a little bit every month. Every single payment you make adds another coin to the piggy bank, increasing the value little by little. So over time, that piggy bank gets nice and fat from feeding it all those coins, and it becomes a significant financial resource for you to use as you see fit. Now you might want to know, how exactly do you access the wealth that's in that piggy bank? Let's break that down in four main ways. Number one, a home equity loan. A home equity loan or a second mortgage is where you take out a loan against the amount of equity that you have in your home. You get a lump sum of cash up front, and then you make some monthly payments over time, pay it back, just like your primary mortgage. Now, the nice thing about a home equity loan and the way that it's better than a credit card is because it's attached to collateral, meaning there's something that the bank can collect if for some reason you defaulted on your payments. So it's viewed as lower risk, and with lower risk comes lower interest rates. Credit cards, on the other hand, they're not attached to anything. They have zero collateral attached, so that's why they have 25% interest rates. Next, we have the home equity line of credit, or HELOC, as you might see. Think of a HELOC as though it's a credit card that's connected to your piggy bank, and you only pay interest on what you actually borrow. This is handy if you don't need all the funds all at once. With a home equity line of credit, there typically isn't closing costs associated with it like there are with a home equity loan, like title fees. Then you have the cash out refinance option. This combines your original mortgage with the amount of money that you're pulling out of your equity, meaning your mortgage balance is at $100,000, but your home is worth $200,000. You can borrow $120,000. This combines your original mortgage with the amount that you're cashing out, say $50,000, into one new loan with one interest rate and one monthly payment. So say you owe $100,000 on your mortgage, you want to borrow $50,000 against the equity, and your home is worth $300,000. You get a new mortgage for $150,000 and one monthly payment and a lower interest rate than you would if you got a home equity line of credit. This option keeps things a little bit more simple by just having one mortgage payment each month. And finally, there's the actual selling of your home. If you're ready to move, selling your home gives you direct access to the equity, minus any fees once the sale closes. Now let's talk about some smart ways to put that equity to work for you. One common way is to buy a new primary residence. You're going to need a place to live, right? Maybe you're ready for a bigger home, you need to relocate, or you want to be closer to family. By selling your home, you can use the proceeds as a down payment on the next one. This is especially helpful for families looking to upgrade to a larger space. Another powerful way to use your equity is to buy an investment property. You can take out a HELOC or a home equity loan and use that for a down payment on a rental property. With renters, you're generating cash flow each month and building equity in a second property. This is how you build generational wealth. And this is a great way to start building a valuable real estate portfolio with multiple homes owned. If you've got some high interest debt, like a bunch of credit cards, some student loans, what have you, using a low interest home equity loan to pay it off and consolidate it can reduce the amount of interest you pay over the life of the loan and save you money in the long run. This is a great way to reduce your monthly expenses and have one single payment rather than 10 bills that you have to pay each month. With current mortgage rates usually being lower than credit card rates, this strategy will definitely save you some money over time. And lastly, just an emergency fund to have put away for yourself. Life can throw you some curveballs, and having a HELOC as a backup gives you that peace of mind. Whether it's a home repair, an unexpected expense, or even a new opportunity, your equity can be a valuable safety net. So let's go ahead and bring this to life with an example. Suppose you've been in your home for a few years and you've built up about $100,000 in equity. You're eyeing up a $500,000 investment property and you need $50,000 to put down. You could take out a $50,000 home equity loan on your current property, use that as your down payment, and have renters cover the expenses. This way you're keeping your current home, you're adding a new one, generating passive income or cash flow, building equity in a second property, and increasing your monthly income. Now, as promising as this sounds, there are some key considerations that you need to keep in mind. First, lenders will look at your debt to income ratio to ensure that you can afford both your current home's mortgage payment and the new home's mortgage payment. It's really essential to keep this manageable, especially if your financial situation has any changes to it. Also, keep in mind that markets can fluctuate. They can go up and down. If property values take a dive, your home equity can do the same thing, or it can be a little bit less than expected. So it's really wise to avoid overextending your finances. So if you're interested in using your home's equity, it can be a great way to invest in some more real estate and build that generational wealth, pay off some debt, or just give yourself a little financial breathing room. But like any financial decision, it's best to weigh your options and consult with a professional. If you're curious about how much equity you can access in your current home, or you want to discuss whether a home equity loan or a home equity line of credit is right for you, reach out. My team and I are here to help guide you. And if you found this helpful and you want some more tips on building wealth through real estate, don't forget to hit that subscribe button. I'll see you in the next one.